Hey everyone, welcome to Pitch Deck Insights. I'm here with my good friends and LP investors, Hans and Mike. And our objective here is to teach you what to look at when you're analyzing a deck for private investment. We're going to go through all the details of decks that are submitted to us by general partners who are interested for us to go over their decks, give us our input, and teach you how to be better LP investors. This is purely informative advice. It's not financial advice. We also have no relationship or connections with any of the GPs. We just want to teach LPs like us to be better investors. So let's dive in. All right, guys. So this is a deck that's called Gish Flats by Loom Equity. Let's dive into it. And Hans, I'll let you kick it off the first slide. What do you think about this?
Yeah, so just a quick comment. There's appear to be two different companies involved here. So the first question I'd want to know is essentially, what is the relationship between these two companies and why are they partnering together versus one company offering the deal? Only other comment I would have here is typically it's great that they put some experience in here, but I personally would want to see much more detailed bios for anybody that is a GP in the deals. The experience in this is rather light. And so I want to understand their full experience in professionally and within real estate to really get a good sense of the GP capabilities.
Mike, anything you want to add about this?
On Karthik, just the idea that he's got a lot of experience as a venture capitalist, investment banker, but he doesn't talk about how much he's been doing with this. And then the other thing I don't know, is he just a capital raiser on this deal, or is he actually a GP partner that's going to be involved long term?
Right. All right. Moving on to the property management team. Mike, anything you want to say about this slide?
Yeah, property management team. I mean, this is the team that's going to be operating this thing down the road and really a key to if this is successful or not. And so this is an important piece. This looks like an outside team that they're paying. That can be good or bad depending on their experience. It looks like they've got quite a bit of experience in this market, which is probably good, with 10% of the inventory in the Lynchburg market being managed by them already. So we got some good knowledge, but this is something to make sure that you're very familiar with them and comfortable with what they're going to do.
Hans, anything to add about that?
No, that's pretty good. Pretty good summary. I would say the last three bullets are kind of boilerplate, and I would want something much more specific about the team.
All right. All right. So macro views and principles, high level stuff. Hans, any thoughts on this?
I like it. It's a very good summary of why they're doing this deal and why they think, why they like this particular deal. And they are, they're doing some things here that I really like. They're paying attention to your debt service coverage ratio. The biggest thing my favorite thing on this entire slide is the fact that they mentioned debt. Debt is your biggest partner in any real estate deal typically. And you're getting into bed with somebody for a really long time, the lender. And so the fact that they're using fixed rate financing and they are using, not a short-term loan, but a longer-term loan with fixed rates greatly reduces the risk profile of the deal. So I do like this slide. It makes me feel much more comfortable to see the type of debt they're using.
Yeah, the only other thing with that is just make sure that your debt term matches the plan for the property. You don't want to have something that you're going to flip it in 2 years, but you want tied up 10-year debt unless it's assumable by the next person, or else the getting out of that can be pretty expensive.
All right. All right. Let's move on here to the market itself, Lynchburg, Virginia. Anything to add about this history, market overview? Maybe we should touch on the market overview for a second. Mike, you want to kick this off here?
Yeah, I mean, one of the things you want to, you're investing in this market, you want to know that it's a certain size. So this is about 85,000 people. They're talking about a decent diversity as far as the colleges and other employment things, just making sure that you know where you're buying it. I think there are a lot of advantages to going into secondary and tertiary markets. I call this a tertiary market, but you just got to make sure that you're comfortable with that.
Hans, anything to add?
I would add that it's great to see the overview of Lynchburg itself, which is the city, but I personally as an LP want much more detailed demographic profile, median income, home values, et cetera, for at least the 1 and 3 mile radius of where the property is located. It's great that you're in a bigger market, but that doesn't tell me much until I know more about the submarket.
Right. And what we're saying about, for example, the data we see here on the quick stats is overall for Lynchburg and not specifically right with the 1 to 3 mile radius.
Yes, that's right. I want to know the immediate submarket demographic profile.
Yeah, the other thing here is that your median household value at 170,000 is a little under what the national averages are. So that means it's going to be a little easier for people in this market to get into homes. So you may have some turnover more, but it is pretty affordable. If you look at what you typically try to stay with is a 30% of your gross income going to rent or less. And the current effective rent in this area is just under 20. So that gives you some ideas, but you want to compare yourself to your property and where you're going to end up on rents to make sure that it's affordable for the majority of people in town. And this looks like a market that you can do that.
All right, cool. Moving on here. I'm going to dive into the employer base because I think that's sort of what we want to talk about, right? Just down here. All right. Hans?
I think the main point of this slide is knowing that there is quite a bit of different types of employers and industries within Lynchburg, albeit I'm sure quite small because Lynchburg isn't that big, but at least the employers aren't exactly, one type of industry or one employer per se. I would be hesitant to invest in deals where, 80% of the employer is due to a military base or a Honda factory or something like that, where basically one employer can leave the town and cause huge employment issues, which causes you to lose tenants because they can't pay. So the fact that this is pretty diverse is great.
Mike, anything to add on this?
The only other thing is just make sure that the data they're pulling is relevant. The slide before it's pulling from a 4-county area, so it's great to know that there's 15,000 jobs regionally, but those people aren't going to be your tenants. It's really like Hans said, you're looking at a few miles away from the property is more important. And so the broad is good, but local is even better.
Are there stats on specific, neighborhoods and the employment status or sectors of that neighborhood? Like, should people look for that or ask for that stuff?
I was just going to say, I don't think there's as much on employers. You'll see sometimes where they'll throw the property in and then give you like a 3-mile radius in each direction as to key employers, key shopping, key things that people are going to be interested in to just kind of get an idea of what type of market it is. But other than that, you're looking at things where you can go 1 3-mile radius for the specific amounts that people are making in that kind of thing versus in the general vicinity.
All right, the property itself, history, machines, property summary. All right, Hans, you want to start talking about these slides of the specific property data and comps?
Yeah, on the property, the first thing that I notice, everybody provides these general stats, which are great, and sometimes most of them are fine. There's not a ton of hugely relevant info here for an LP, other than if they were, say, all 1-bedroom studios or something like that. Then you better have a very specific business plan for the entity. I'm sorry, for the property, if it only has one unit type, et cetera. The biggest thing that jumped out to me here is the age of the property. It was built in '83. And so, and it was renovated in 2016. So my biggest question here would be, was the 2016 rehab, did it modernize the infrastructure? One of the biggest downfalls of any multifamily deals that I've been involved with or seen in the industry is infrastructure such as plumbing, electrical, roof, going bad during the course of ownership and causing huge CapEx expenditures. And so because of the age of this property, I would really want to be sure as an LP that it doesn't have galvanized pipes, that the plumbing has been updated, it doesn't have copper wiring, et cetera, et cetera. All of this has been updated so that there's not going to be any unforeseen CapEx expenditures during ownership.
So basically what you're saying is that it might exist, it might have happened, but it's not presented in the deck. And it's
right. We don't know. We don't know if that rehab was to put in new flooring or to update plumbing and electrical. I'd want to know that.
Right.
Right. Is it being heated by a boiler from the, early 1950s and there's no AC, or is it something where they put in all mini splits and everything's efficient and that kind of thing? The other thing here, a 5-story complex on an older building can be really cool. Again, it depends kind of how the layout is. And then the only other thing that jumped out at me here is our average rent is $985 for the market. This is $1,089. So you're not too far off market. That's another thing you want to make sure that you're not double what the market is or something like that in where you're getting far away from it.
Right. All right. Let's do the property location itself.
Yeah, well, I was just going to say, I mean, it's in a great location. If you look, the downtown, it looks walkable to the James River. It's walkable to sort of this whole downtown area. When I did the Google Maps thing, that looks interesting. I don't know Lynchburg at all, but there's potential of why people would want to be there. So that's something to know of what your property looks like that way.
Some photos and then diving into the comps. So high level, this is where it really gets interesting, right? Diving into the meat of the deal itself and what they're taking into account. So Mike, you want to start with any quick insights on like the slides, the 1-bedroom units, 2-bedroom units, like anything specific you want to dive into here?
Well, the rents, it's pretty hard to tell a lot with this. It's just sort of tough to know the relevance. You've got two of the things that they've listed where they're under what these guys are asking for already, and they're planning on raising rents, and then just one property with 9 units that's higher. It's just not enough information here for me to really know, are their comparables good? Is it reasonable to go to? And I saw the same thing on the 2-bedroom units, just not a lot of data there.
Hans, what would you add on this?
100% agree. I mean, my first glance at this, when I see a rent comps page, I want it to be very clear as an LP. The story should be told without me having to try to fish it out as to what the value add is. If you're showing rent comps, then you're probably showing that you can increase rents. And in this case, the subject property rents are above the two of the 3 comps in both the 1-bedroom and 2-bedroom units. So what is actually their reason for them saying they can increase rents to $11.36 a door? And then the next question I ask is, well, what does that even mean? They don't make it clear what that means, increase to $11.36 a door. Does that mean we do $50 a door for 1-bedrooms and X dollars a door for 2-bedrooms? They really need to provide a lot more comprehensive summary and analysis of rental comps and how that's going to help them reach their value add plan for an LP. The LP shouldn't have to try to figure it out.
Right. And again, I'm not trying to protect the fund here, or the GP. I'm just saying it's possible this information is in their materials, but the fact that they're not saying more and diving more into it is missing here on the deck, right?
It should be in the deck, but the deck is what an LP based.
I agree, 100%, 100%. Sales comps.
Sales comps, they just, in general, they didn't mean much to me at all because the properties don't appear to be true comps. They're very different type of properties.
Yeah, most likely they're a long ways out in the suburbs. You don't have those kind of things in the downtown core, like where this property is. The other thing, just to mention, there's a lot of dates in here are all 22, and especially later for things that they're going to do this. So I'm going with the assumption that this is an old deck that they've already raised the money for and closed on. Otherwise, that would be something where these comps are too old.
So to sum that point up, it's an important point. It's important to look at what comps are in terms of dating and then compare it to what we're seeing in the market today. Because if it's an old one and it's an old deck, you're right. But we'll see in a second. This is an old deck. This is a deck from 22. All right. Hans, anything about the business plan here?
Well, in general, the increased revenue is the important part here. And I kind of go back to what I said. I want to understand why they can increase to $11.36 a door. I want to, the main reason you're able to create any kind of value add in a multifamily deal is one of 2 things. You either increase occupancy or you increase rents. Yes, you control cost, but that's a given. Everyone should be able to control their costs. You don't value add. You don't buy based on cost. You buy based on the potential to increase revenue. So I think there needs to be much more detail about how they're actually achieving this value add and how are they getting this increased to $11.36 a door average for the first 12 months. It's in general, it's not totally clear to me looking at the business plan here, what the value add strategy is. And that's the first thing that I look for. There must be a value add in any deal I invest in. In this one, I'm just not entirely clear what it is.
Right. So how they're achieving the increase. Mike, anything you wanted to add on this?
Yeah, the 1136 is only 4.7% above the 1085 they're at now. So that's reasonable if there's a plan, but it's a lot to do in the first 12 months too, because you've got a rolling, leases unless everyone's in there on month to month. And so it's one of those that it can be harder, even if they're behind market, to get those in. And then the build back utilities, internet, I don't know what valet trash is, and parking. Those are fine, but how are you going to do it? What's the plan? That's a big impact, and you kind of want to know what that's going to look like, and to know if it makes sense or not. The continued medium-term rental program, that's concerning to me, because a medium-term rental program, that's more of a business than a straight up thing. So that's going to be very dependent on your property manager. Have they been doing this? Are they used to it? What's that look like? And you can have something like that come into an investment like this and add to your IRR, but you need to know what that looks like, how many are in there, that kind of thing. And then the non-refundable move in, move out fees, there's pros and cons with that. So they're exploring it, but again, it doesn't really tell me too much that way.
I'll just add one other comment on this medium-term rental program. Assuming what this means is that they're talking about doing like corporate rentals, I guess, maybe that's what they're talking about, 3 to 6 months, possibly.
Assuming that it was furnished spaces, that there's
Yeah. So
3 to 5 units that are furnished,
right.
And they're not that way.
My point being is that many lenders, especially agency lenders, they don't like these kind of programs. So does a lender even know this is happening? Most of these lenders, Fannie Mae and Freddie Mac, that lend on these type of properties, they lend for long-term workforce housing, usually lease normal apartment leases, not these shorter term leases with different kind of programs. So you have to be, that would be a question I'd be asking the GPs: is this okay by the lender? How long has this been going on the property? If you're going to continue it, is it going to be okay with a new lender that's on the property, et cetera, et cetera? A bunch of questions come up when I see that.
Right. Yeah, there are a lot of questions from this slide. All right, diving into the track record. So they've supplied basically 2 case studies of historic deals that they've done. Mike, we want to kick this off on like this first case study that they did in Virginia.
Yeah, sure, they had good results with this, with reducing expenses, renovating some units, increase market value. But was this cap rate compression? Because certainly from 2018 through 2021, there was a lot of cap rate expansion during that time frame. So how much was it them executing their plan and getting the net operating income up versus how much of it was market forces that wouldn't have mattered who owned it? The other thing I like to see with something like this is what was the pro forma versus what were the results? Let me know from some of these case studies how you've done compared to what you expected to do.
I can say from an investor standpoint, like I want to see if, like you mentioned, all right, if what like investors were assuming a certain IRR, what are they seeing today based on those assumptions or compared to those assumptions? I'm assuming this hasn't exited yet, but even based on that, there are some assumptions you can show and share with previous results on that, right?
Well, when you do a cash out refinance, which is what it looks like they did, for the 21 valuation, you can convert that into an IRR at that point in time, because you would have had the option to sell it at that time, but they've decided to keep it. So I don't mind that part. But they have more math here to do and a few more things to show.
Yeah, but ROI means nothing if it's not taking the time into account. And I like seeing the annualized return comp. That's the only thing you compare apples to apples with, like even anything else. I don't know. That's for me. Hans, what do you think?
I generally agree with Mike said. We don't know that it's just cap rate compression. It'd be very easy for them to show how much they increased the NOI since purchase and how they did it by increasing rents. Instead, they just push valuations here, and valuations in 2021 were frothy. You could get appraisals for anything. Debt was so low, so of course you can get good refinances because you have incredibly low interest rates. Your debt service coverage ratios are easier to cover, et cetera, et cetera. So without knowing where they started with NOI and how much they increased it as compared to what they projected, I mean, this is great. Looks like they did well, but it doesn't tell me much. And when I see 210% return on investment on year 3 anniversary, how's that calculated? I've seen this calculated so many ways. People, include return of capital, et cetera, et cetera. Does that mean that if they sold it, it'd be a 210% return on investment that day based on appraisal? We don't know. So it's not totally clear. Again, this is like one of those slides where there's some good information on it, but they need to clean up telling their story in a much more clean manner.
So you guys, I will butt in on this because as an investor, none of this means anything to me as the investor. This is all on the property level. Like, what are the investors that invested in this deal? There might not have been any investors. Maybe this was just like their own money or whatever. But what do they see? Like, the property forecast to cash flow, that's property, right? The return on investment is on the property level.
What I'm reading this is that they did a refinance. If I put in 100,000, I got back my 100,000 plus another 110 is what I'm looking at this. And then after that refinance is done, I'm at a 50% cash on cash return on my initial 100. If that's all true, those are amazing results.
Wait, but you're assuming this means to investor and not the deal level.
But we don't know that. They don't tell us, but
exactly.
that's what they need to tell that story better, give us more details and sort of tighten that stuff up so we know what it means.
Hans, do you think this is for the investor or this is on the deal?
It's like I said, it should be on the investor because that's how they're presenting it. Somebody that would be reading this would think that, like Mike's thinking, but honestly, I don't trust that it is. And again, it doesn't make sense. It almost mathematically, I don't know how you'd make 15% cash on your original return when you returned 210% of the original investment through a refi. The property would have had to, I mean, maybe it's possible, but again, this is why I need to understand more details and have more calc.
All right, let's see the second one.
Same general comments. My only comment here is I love the fact that there's a $200 increase here that they mentioned. But was it across all units? How did they achieve this?
Yeah.
The other thing this is the soft offer valuation holds a lot less weight for me than what a real, like an actual refinance that a bank, did, or especially if you actually sold it and went round trip.
Right. But I mean, if they haven't sold it, would you say, and they do have this soft offer, should they mention it or should they not mention it here on the deck?
Yeah, no, they should mention it. I mean, I'm just saying there's more to tell here, but yeah, I mean, if everything's right, that's a good story.
Right. Yeah. And I guess if this was a deck from 22 and this is 21, there's not enough like real data to share with investors as to performance, but yeah. All right. Moving on to these financial highlights. Hans, what do you think about this?
Well, it's a decent summary of the returns. I mean, one of the first things that jumps out at me that is they're using average annual return here. And let me back up. The first thing I want to see in any financial information here is I want to see I want to see a pro forma profit and loss. I want to see a sources and uses statement. I don't even know how long the term of the deal is. I think it's a 5-year term, but it's not clear here. So there's a lot of details that are lacking. This is kind of an overview, and I'm glad they gave us some details on the loan and the high level returns. But there's really no way to be able to tell what the true P&L is. That is like the first thing that should be included is a pro forma profit and loss that shows the trailing 12, trailing 3 income, historical, and then every year after, and then how you're getting to your cash flow and your distributions from your value add improvements, and that is not provided here. So this is just kind of a summary slide that has some information on it, but not nearly enough.
Agree. I'd like to see before this slide, even that one page that has kind of that overview of the plan and where they're at, where they're going on key points.
Yep.
Right.
The other thing to look at here, which that would do is, 7% cash on cash. Is that being distributed from year one? Is that an average, that kind of thing? And then the skin in the game, sponsors contributing 10 to 20% equity. That's great. That's going to be 340 to 640,000 in this deal. But if you go the next slide under deal terms, they're getting 244,000 in acquisition fee and loan guarantee fee that's right up front. And so, is that just being reinvested? Likely. And so that you can kind of take out, you want to kind of balance those two out to see what the amount of real money they're putting in is.
Wait, where did you see their management fee?
Go down to the next thing. So what they have is the 2%
Okay.
acquisition fee and a 1% loan guarantee fee. So, and that's going to be on the whole deal, on the whole cost on the acquisition fee, and then the whole loan on the loan guarantee fee. Probably, you don't know that for sure, but usually that's going to be on the whole loan. And so I calculated those to be worth 244,000 that the GPs are getting up front on this deal. So when you go to the skin in the game, I kind of like to back out the fees they're getting from the amount that they're putting in to see what the net impact is that they're putting in besides the fees they're gathering.
So a couple of comments. The 1% loan guarantee fee, very standard for the industry. That's fine. However, I don't like to see it on a recourse loan, on a non-recourse loan. I believe they're doing some sort of an assumption loan here of an agency loan. And if they are, that means it's non-recourse, meaning that they can hand the keys back and they don't have their personal assets are not at risk for defaulting on the loan. So I don't really think sponsors should get paid to sign on a loan where they take no risk. Now, if it's a recourse loan, different matter. I'm totally cool with a 1% loan guarantee fee. Kind of with the refi fee, I have the same question. Is that going to be on the whole loan? So do they get paid again when they do a refi, or is it just on an incremental increase? They increase the value, so they increase the loan amount. Are they getting it on the incremental increase? It should be on the incremental increase and not on the entire loan. And then my final comment here is on the waterfall. If you notice, it's a 7% pref and then a 70-30 split up to a hurdle rate. Number one, the hurdle rate is an average annual return, AAR, and is not an IRR. I would much prefer to see an IRR there because IRR is the true time value of money, and it measures your return over a specific time versus average annual return, which is just like it sounds, an average. Most sophisticated sponsors use an IRR as a hurdle rate. But my biggest issue here is the 51-49 split above the 15. These sponsors, if you look at their bios and their track record, they're relatively inexperienced. They've only done a very few deals, not very big deals. And so to have a 7 pref and a 70-30 and then a 51-49 split, to me is awfully aggressive considering the track record and experience of these general partners. If they were extremely experienced, I have no problem them taking a higher split above a 15 IRR, not ARR. But that's one of my biggest problems with their waterfalls. I think it's just too aggressive for their experience level.
Yeah, I've never seen 51-4. Like it's really weird. Like that isn't that I've seen 70-30 and then a 50-50.
I guess 51-49 sounds better than 50-50. I don't know. I don't know why they would do that, but either way, it's too aggressive.
Yeah. I agree on that.
15 is too low to jump to that. If that was at 20 or 22, I'd be completely fine with it. But at 15, agree, their experience level doesn't seem like it. The sale refi transaction fee, I don't like to see those. I mean, it just seems like an extra fee for people unless it's recourse. This one says in the slide above Fannie Mae backed loan rate, it doesn't even tell you that it's locked in. So I'm hoping that it is, but that'd be something I'd want to know there. It should be a non-recourse loan. And so there'd be no reason for the loan guarantee fee.
Yeah, the loan is an assumption. So that's why there's no rate lock worry there.
Okay.
Right. All right. All right, guys. I think we're going to end this deck review insight here. Is there anything you want to add before we wrap it up?
This is just kind of a quick summary of the cash, which I do, and this is good because it's showing you as an investor what they're projecting you'll make on a yearly basis, which is great. You always want to see this in some form or fashion. But what I'd want to do is I want to see this at the bottom of a slide or on an additional slide on top of actually seeing the pro forma P&L. But this, I will say this slide, you should have some slide in every deck you see that gives you this general data. It's always going to look a little different, but you need to be able to understand, you as an investor, what you're projected to make on an annual basis.
The other thing I'd like to comments, or I would like to see him comment on is since it's a 7.5 year term left on the loan, and they're planning to do a cash out refinance, it looks like at year 5. What happens to the loan? Are there any fees for that? Just recognize that.
Yeah, I think they're doing a sale in year 5, Mike.
Was it? Okay.
The sale in year 5. And my guess is since it's a loan assumption, the prepay is mainly burned off by then.
Yeah, they're assuming a 5-year hold, and then they're talking about that refi, right? Because they probably put that into the numbers.
I don't think there is. If you go down to the last slide we were just on, if there's a right there, if there was a refi, you would see a large return in one of the years of capital, and there's not. So I don't believe there's a refi here. I think that's a loan assumption and a sale in year 5, unless I'm misinterpreting.
No, yeah, well, I think people, I don't know. You don't usually see refis in the projections. It's just something that's on the table for them to do. And when it happens, it increases.
Oh, you do. Promise you, I do. You do see them. I'm testing a deal right now that has a refi in year 4, and it has 70% return of capital in the projection. So you would see it on if the deal I'm investing in right now had this slide, you would see it in year 4. You'd see like cash flow of 78.40, and then there'd be like $70,000 return of capital. That's what you would see there.
I don't know. Projecting a refi is it's such
it's part of the business plan. It's definitely part of this.
Well, I agree. Yeah, but it's so dependent on the economy. That's crazy.
Well, then
so is the same.
So are all the rents, so are everything else. I mean, everything here is a wag a little bit.
That's what we skipped. The disclaimer slide. I mean, all of this stuff is just a guess, and so this is just their plan and of what it's going to be. But I agree, there's no way to know what refi, if you'll be able to refi, will you hit these rents? Will this plan work or not? It's going to be off. It's just which direction and by how much.
I just think there are things that are dependent on the operator or more dependent on the operator. And there are things that are totally non-dependent on the operator. And I sort of, in my mind, separate those two things. But you're right. I guess it's very subjective.
Yeah. One other comment I want to make here that I didn't see anywhere in this deck, we went through it rather quickly, but they have a sale, but where was the, what is their going in cap rate? And what did they use for their reversion or exit cap rate? Nothing is provided there. No basis for thought process of why and how they got to their sales price. So that's one of the first things I would look for, and I would be asking these.
Right.
Yep. And then I think 4 slides later, what happens after closing. The other thing that they didn't mention up till now, but just is the one more there, the received tax package. 60 to 70% depreciation is pretty high for multifamily, unless there's something unusual going on with it. So I would want them to explain to me how they were getting it that high. A lot of times when I see it that high, there's higher leverage. They certainly don't have a 1.7 DSCR coverage ratio, or there's something where it's a land lease or some other deal where the entire purchase price is able to be cost segged out.
All right. So basically we just ran through the deck. We gave our input. Obviously there's a lot more to dive into. There's a lot more material we're assuming missing that might have been in addition to the deck that an investor would receive over email. But just based on this deck, Hans, what are your top 3 conclusions you take from this deck?
I think that, the feedback I think I would give these sponsors is it needs to be a lot more comprehensive. You need actual your financial projections in there. You need cap rate details in there. And the waterfall is just too aggressive for their experience level. Those are my takeaways on a deal those are just off the top of my head.
So Mike, what are your top 3 conclusions from this deck?
Interesting building, need more information, and just need a lot more of the history behind it and the story on the sponsors, the deal, some of the rents, the comparables, all that kind of stuff.
Right. So I think at the bottom line is there are some comps and deal terms that don't really make sense to us. And 2, we're missing information that should have been presented in the deck that would help better understand the deal while we're reviewing the deck, right? So I think that was awesome. Let's wrap this up. Until next time, make sure you guys do your due diligence, find those good operators, Personally, I do a lot more trusting of the GP than I do diving into decks. So I'm learning a lot from this. So I appreciate you guys. And let's keep on teaching LPs how to better invest and GPs how to prepare their decks better. Have a great week.